Do U.S. remote employees working in Canada create tax obligations? A U.S. company might assume that if someone is hired under a U.S. contract and paid through U.S. payroll, everything stays under U.S. rules. That assumption breaks down as soon as the employee lives and works in Canada. For tax purposes, what matters is where the work is actually performed and where the employee is resident, not where the payroll server sits. So, yes, US remote employees who live and work in Canada can absolutely create tax obligations. Those obligations can exist for the employee, for the employer, and sometimes for the broader corporate group, even if there is no subsidiary or formal branch. How Canada sees a remote employee in Canada. From Canada's point of view, a Canadian resident individual working physically in Canada is earning employment income in Canada. That income is part of the Canadian tax base. The fact that the employer is a US company and the payroll is run from another country does not change the character of the income. In many cases, the remote employee will be resident in Canada for personal tax purposes. That means they are taxable on their worldwide income in Canada and will report US employment income on a Canadian tax return, claiming relief under the treaty and foreign tax credit systems where applicable. It also means that Canada expects appropriate withholding at source if the employer is functioning as an employer in Canada's eyes. Employer payroll obligations for remote Canadian workers. If you employ someone who lives and works in Canada, Canadian rules generally expect you to withhold income tax and social contributions from their pay, remit those amounts to the Canadian authorities, and provide year-end slips summarizing what was paid and withheld. That expectation exists even when the employer is a US company with no formal Canadian entity. Practically, this can force the US employer to decide between several paths. One option is to register directly for Canadian payroll as a foreign employer, run a proper cross-border payroll process, and handle T4 reporting. Another is to use a Canadian employer of record that becomes the legal employer for Canadian purposes and takes on the withholding obligations. Keeping the employee purely on US payroll with no Canadian withholding and no Canadian reporting is rarely compliant in the long run if the person remains in Canada indefinitely. Permanent establishment risk from remote work. Beyond payroll, there is the question of whether a remote employee in Canada creates a permanent establishment for the US employer. Under treaty rules, a permanent establishment usually involves a fixed place of business or a dependent agent who habitually concludes contracts in Canada. A remote employee answering emails and doing back office work from their home in Canada may or may not cross that line, depending on their duties. If that person is a key salesperson or executive who regularly negotiates and finalizes deals with Canadian customers, it becomes easier for Canada to argue that the company now has a permanent establishment through that employee. If that argument succeeds, the company may be taxable on business profits attributable to the Canadian activity. The important point is that payroll obligations can exist even without a permanent establishment, and permanent establishment questions can arise separately. They are related but distinct analyses. Impact on US payroll and benefits. From the US side, having someone relocate to Canada while staying on US payroll also raises questions. The home state payroll system may not understand foreign tax credits or the employee's new residency position. Social security coverage and pension contributions may need to be coordinated under international agreements. Health benefits designed around US healthcare may not function the same way for someone living in another country. All of that matters because a messy cross-border situation can leave the employee paying more tax than necessary or losing access to benefits they thought they had, which in turn can create legal and HR issues. Why classification matters even more across borders. Some US companies try to keep remote Canadian workers off their radar by classifying them as independent contractors. That approach might delay payroll registration, but it depends entirely on the relationship being a genuine contractor arrangement under Canadian law. If the day-to-day reality is that the person works like an employee integrated into the team with a set schedule and little business risk, Canada can reclassify them as an employee. When that happens, the company can be held responsible for back payroll deductions and employer contributions. Across borders, misclassification risk is amplified because authorities may be especially skeptical of arrangements that appear designed primarily to avoid registrations and remittances. Final thoughts. US remote employees who live and work in Canada do create tax obligations. At a minimum, their employment income becomes part of Canada's tax base. In many cases, the US employer is expected to register for Canadian payroll or use a local employer of record model to handle withholding and reporting. On top of that, a careful look is needed at whether the employee's role might create a taxable presence for the company in Canada. If you currently have or are planning to hire remote staff in Canada while staying entirely US based on paper, it is worth stepping back and mapping the tax and payroll implications before those relationships become long-term fixtures. For more practical breakdowns like this, you can visit www.theaccountingandtax.com. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.